Crypto in 2025 is more volatile and more opportunity-laden than ever before. Between institutional flows, AI tools, evolving regulations, and new assets like tokenized real-world assets and DeFi derivatives, traders are navigating a complex, shifting landscape. So how do you stay ahead, minimize risk, and maximize returns? In this video, you'll discover the top trading strategies for crypto in 2025. What's working now, backed by research and real data, plus a case study showing how one smart strategy crushed the market. Let's jump in.
Segment 1. Why trading crypto in 2025 is different. The macro environment is shifting. Increased institutional adoption, regulatory clarity in some jurisdictions, but also more regulatory risk in others. AI and algorithmic tools are increasingly available. Sentiment analysis via social media, on-chain data is more accessible. New assets, DeFi tokens, real-world asset tokenization. Liquidity in some new tokens, more risk in others. Always, volatility remains, but risk management is more critical than ever.
Segment 2. Top trading strategies for crypto in 2025. Here are 7 of the best strategies with when and how to use them. 1. Trend following. How it works. Trend following aims to profit by identifying and trading in the direction of a sustained price trend, either upward or downward. Traders use indicators like moving averages, MACD, RSI, and Donchian channels to confirm trends and enter positions. Positions are held as long as the trend remains intact, exiting on reversal signals, such as moving average crossovers or RSI overbought or oversold levels. Pros: can capture large, sustained market moves for substantial profit. Relatively straightforward to apply with clear signals. Helps traders avoid fighting the market momentum. Cons: entries and exits can be delayed, missing early profits or late exits causing losses. False signals in choppy or sideways ranges can lead to losses. Requires discipline to stay with the trend through volatility. Best conditions: strong, clear trends with stable momentum in either direction. Markets without excessive whipsaws or sideway ranges. 2. Swing trading. How it works. Swing trading targets medium-term price movements, lasting days to weeks. Traders look for price swings within trends or cycles using technical analysis tools, candlestick patterns, volume, moving averages, RSI, to identify entry and exit points. The goal is to capture larger moves than day trading, but in less time than long-term investing. Pros: balanced time commitment and profit potential. It's easier to manage emotionally than very short-term trading, and it's suitable for part-time traders. Cons: exposure to overnight and weekend risks. It needs knowledge of technical analysis, and it can be affected by sudden news events. Best conditions: moderate volatility with distinct price corrections or retracements, and liquid assets with good volume and trend clarity.
3. Day trading or scalping. How it works. Day trading involves opening and closing trades within the same day, while scalping is an ultra-short-term form targeting small price moves over minutes. Traders use very short interval charts and indicators like Bollinger Bands, candlestick patterns, and RSI to find quick profits from intraday volatility. Pros: can generate consistent small profits. No overnight risk as positions close before the day ends. Takes advantage of frequent price fluctuations. Cons: highly time-consuming and mentally taxing. Requires advanced skills and fast reflexes. Trading fees and slippage can reduce profitability.
Best conditions: assets with high liquidity and volatility. Example: Bitcoin, Ethereum. Arbitrage and inter-exchange opportunities. How it works. Arbitrage exploits price differences for the same cryptocurrency on multiple exchanges. Traders buy on an exchange where the price is lower and sell on one where it's higher, profiting from discrepancies caused by market inefficiencies, latency, or liquidity differences. Pros: low exposure to directional market risk. It takes advantage of fragmented global markets, suitable for risk-averse traders. Cons: margins are usually small, requiring high volumes. Transaction and transfer fees can reduce profits. Speed and execution risks due to transfer times between exchanges. Best conditions are volatile markets with asynchronous price adjustments, exchanges with fast withdrawal and deposit processes, and low-fee environments. 5. Grid trading, including dynamic grid. How it works. Grid trading places multiple buy and sell orders at set intervals above and below a base price, profiting from price oscillations. The dynamic grid adjusts these intervals based on market volatility, optimizing trade frequency and profit. Pros: automates profits in sideway or range-bound markets. Does not require market direction prediction. Can provide steady income in volatile but sideways markets. Cons: performs poorly in strong trending markets with runaway prices. Requires proper grid setup and monitoring. Can be capital intensive depending on grid size. Best conditions: range-bound or consolidating markets with predictable price oscillations. Moderate volatility. 6. AI/ML driven and algorithmic trading. How it works? AI and machine learning models analyze large data sets, including price action, sentiment, and news, to generate trade signals and automate execution. Algorithmic trading follows preset rules and can adapt dynamically based on AI insights. Pros: eliminates emotional bias and human error. Can process complex market data in real time. Executes trades faster than humans. Cons: requires significant technical skills and resources. Models can malfunction or fail if trained on poor data. Needs continuous monitoring and updating. Best conditions: highly liquid, data-rich markets. Environments with frequent market-moving news and volatility. 7. Fundamental and sentiment-driven strategies. How it works. Fundamental trading analyzes a cryptocurrency's project health, team, tokenomics, adoption, and on-chain metrics to assess long-term value. Sentiment-driven trading gauges the market mood through social media, news, and forums to predict price moves influenced by hype or fear. Pros: it provides a basis for long-term investing decisions beyond charts. It can anticipate major directional moves before they show technically. It helps avoid speculative bubbles or crashes. Cons: it is time-consuming and research-heavy. Sentiment can be manipulated or misleading. It is not ideal for short-term trades. Best conditions: longer-term market outlooks. Periods before or after major project developments or news cycles. When social sentiment or fundamentals strongly diverge from price. Segment 3. A case study. Dynamic grid trading versus buy and hold on BTC/ETH and 2021 to 2024. Based on the 2025 research paper, Dynamic Grid Trading Strategy from Zero Expectation to Market Outperformance by Chen, and Zhang. They tested the dynamic grid-based trading DGT strategy using minute-level data from Bitcoin and Ethereum between Jan 2021 and June 2024. What DGT did differently, instead of a static grid of equal spacing, it dynamically resets grid positions based on volatility and market structure. That way, when volatility increases, grid widths adjust. When trend starts, the strategy adapts. Results: the DGT outperformed both traditional grid strategies and buy and hold in terms of return and risk metrics. For example, over that period, it delivered higher internal rate of return, IRR, and better drawdown control. Takeaway: passive or semi-passive strategies like grid trading can work if they are adapted intelligently to market conditions. This is key in 2025 as markets are more dynamic and noisy. Segment 4. How to choose and combine strategies. Know your time horizon and risk tolerance. Are you day trading, swing, or long-term? Bigger yields often come with more risk and stress. Diversification across strategies. Don't put all capital into one method. Maybe use DGT or trend following for some, AI-assisted swing for another. Backtesting and ongoing evaluation. Use historical data to test any strategy before using real funds. Tools like 3 show how backtesting with AI bots helps optimize strategy and risk. Strong risk management. Use stop loss or take profit. Limit leverage. Have rules for maximum drawdowns. Only trade with money you can afford to lose. Keep an eye on fundamentals and news. Regulatory changes, macroeconomic factors, inflation, rate changes, major exchange hacks, etc. These can abruptly shift markets. Segment 5. Common pitfalls and what to avoid. Overfitting models on past data without validation. Ignoring fees, slippage, withdrawal limits, they can kill profits in high-frequency trading or arbitrage. Emotional trading and FOMO. Chasing low-volume tokens or projects with weak fundamentals. Neglecting regulatory risk, especially as more countries clarify crypto laws. Segment 6. What's likely to work best in 2025? Dynamic automated strategies, grid, AI/ML, that adapt to volatility. Combining sentiment plus on-chain plus fundamental filters to weed out speculative noise. Trend following in big assets like BTC and ETH with safe entries and stop losses. Using arbitrage opportunistically, especially across exchange inefficiencies and D5 versus CX gaps. Hedging via futures or options where available to protect position risk. In summary, there's no one-size-fits-all strategy, but smart combinations of trend following, adaptive grid systems, AI tools, sentiment, and fundamentals, backed by disciplined risk management. Those are the pillars of what's working in crypto in 2025. If you like this video, hit like and subscribe to get more research-driven crypto strategy content. Also, drop a comment. Which strategy are you most interested in trying? See you in the next one.
Disclaimer: this video is for educational and informational purposes only and is not financial, legal, or professional advice. Always consult a qualified advisor before making any decisions.